Welcome to this explainer. Okay, today we're diving into a genuinely fascinating and frankly kind of dangerous discrepancy that's just hiding in plain sight across the renewable energy sector. We're looking at the massive gap between the theoretical financial models used to justify battery energy storage systems, or BESS, and the actual physical realities these assets face out in the wild. If you're anywhere near asset management, project finance, or grid stability, you absolutely need to know about this gap.
Look, we really have to ask ourselves a tough question right up front. Are the standard, comfortable industry assumptions we rely on day in and day out actually masking a devastating financial time bomb? It's so easy to stare at a spreadsheet and feel completely secure. But what happens when those pristine numbers meet the harsh reality of the power grid? Well, as we'll see, treating a massive physical battery like a simple math equation is a recipe for disaster.
To unpack all of this, here's our game plan. We'll start with the myth of linear degradation, move through the physical reality of battery breakdown, examine the brutal financial consequences, and wrap up with 3 actionable risk management strategies.
All right, let's jump straight into number 1, the linear degradation myth.
If you've ever looked at standard financial models for utility-scale battery storage, you know the drill. You almost always see this neat, perfectly predictable augmentation slot scheduled right around year 7 or maybe year 10 of a project's life cycle. It's treated as an absolute given. The model just assumes that a decade from now, you'll simply swap out some racks, top up your capacity, and keep printing money exactly as planned.
But here is the massive disconnect. We are pitting the tidy, predictable, gentle downward slope of theoretical lab aging against a harsh physical reality. In a climate-controlled lab, sure, battery degradation looks like a nice linear slope, but once you look at actual field data, linearity goes completely out the window. Honestly, relying on those gentle lab aging curves for real-world financial planning is exactly where the trouble begins.
Which brings us to part 2, real-world battery abuse.
Because, let's be real, the grid is not a laboratory. When we look at the actual data, we see assets running incredibly hard under aggressive frequency containment duty cycles. The grid constantly demands these rapid, aggressive responses just to maintain stability, and the battery? It's the shock absorber. It takes the absolute brunt of it. That demanding reality fundamentally destroys any initial financial projections of smooth, linear degradation.
And, it doesn't even stop there. Add multi-market optimization into the mix, where your battery is constantly chasing different pricing signals and revenue opportunities, and you get incredibly high duty cycles. These patterns demand far more from the physical battery than the initial models ever accounted for. We're basically asking these assets to run an all-out sprint, while the financial folks modeled it like a casual Sunday stroll.
So what actually happens inside the box? Section 3, the physical breakdown.
It really boils down to a brutal chain reaction. First, you have that high-throughput cycling and those deep discharge spikes just hammering the cells. Second, all that operational stress physically wrecks the battery structure. We're talking drastically accelerated microcracking and lithium plating, way faster than any lab test suggested. And third, all that physical trauma equals premature capacity fade. The battery literally cannot hold the charge your spreadsheet says it should.
And that leads us to the terrifying part for investors. Section 4, the CapEx shock.
This physical reality completely blows up those scheduled augmentation roadmaps we talked about earlier. Because of that rapid, premature fade, asset owners are suddenly waking up to unexpected mid-life rack replacements. Remember that comfortable year 7 upgrade slot? Yes, scratch that. It's gone. Owners are forced to buy and swap racks well ahead of schedule just to meet their basic contractual obligations.
And here is the brutal financial consequence. If you're treating augmentation like a fixed date on a calendar, you're going to get caught totally flat-footed. As the source material bluntly points out, these hidden capital expenditures will quickly shred long-term internal rates of return. I mean, literally shred them. Your day 1 modeled profit just evaporates because you're suddenly dumping millions of unexpected capital back into the project just to keep the lights on.
Okay, let's talk about how to fix it. Section 5, 3 risk management strategies.
Thankfully, there are ways to protect your investment here. The source material outlines 3 absolutely crucial strategies. First up, you have to ditch the calendar entirely. Augmentation has to be treated as a dynamic, data-driven threshold. When the battery data says it's time, it's time. Second, you've got to rigorously monitor your field data, especially when you're running those high-duty cycles. And third, ensure your field degradation tracking models actually sync up with your financial assumptions. Your engineers and your finance team need to be speaking the exact same language.
So I want to leave you with this final critical question directly from the research to take back to your asset managers today. Are your field degradation tracking models truly matching your financial assumptions, or are you secretly seeing faster than expected capacity fade under high duty cycles? Seriously, take a hard look at your data on this. Getting it right is literally the difference between a massively successful project and a complete financial disaster. Thanks so much for joining me on this explainer, and keep asking those tough questions.